I think in the first half of the year, you could see gold up to 2,500. You can see silver at 50 in that 2023 to 2030 timeframe. Yeah, I think the sky's the limit.
Please join us for our next live stream Sunday, January 16th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, January 16th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you're new to our channel or if you haven't already done so, please do subscribe, hit that bell to be notified of new updates, and give us a thumbs up. We really do appreciate these thumbs ups, and they go a long way for us. David Hunter, Chief Macro Strategist at Contrarian Macro Advisors, joins us once again today. David is an investment professional with 25 years of investment management experience and 20 years as a sell-side strategist with a strong expertise in macroeconomic analysis and portfolio management. This, combined with a contrarian philosophy, has allowed David to forecast economic cycles and spot market trends well ahead of the consensus. Intellectually honest, independent thinker, comfortable with charting a course apart from the crowd, David is an accomplished stock picker and value-oriented portfolio manager. And we're delighted to have David join us once again today. It's time to saddle up and silver up for David Hunter. David, welcome back to SBTV. How are you doing?
I'm doing great, Patrick. Thanks for having me.
David, you've noted the resilience of the markets and how the markets simply keep going up. And that word resilience, I found it pretty interesting. Can you define what encompasses the resilience of the markets? And in plainly speaking here, what in your view is contributing to the market's continuing upward trend?
Sure. Certainly, all the liquidity in the system, all the money that's been pumped in, speaking specifically of the U.S. market, certainly the Fed's done more than their share of the part to keep it moving. We've seen $5 trillion come in the last couple of years. So that's certainly a big part of it. But beyond that, it's also the wall of worry, the skepticism. The market continues to be able to climb because people keep looking for the exit. And even though right now, or at least certainly over the last few weeks, people seem to be getting more on board and talking about a melt up, talking about the market going higher. Underneath the surface, you still had everybody talking about, but this is the last gasp. When's the Fed going to raise rates? And once they do that, it's all over. So you still have an awful lot of skepticism out there. And that's been the case for most of the last, 20, 21 months. And it's allowed this thing to keep kind of rejuvenating every time it starts to reach a point where there's a little bit too much bullishness. It pulls back, gets people more bearish, and then it goes again. So I think sentiment has remained subdued, and certainly the fundamentals from an earnings standpoint have been strong. All that money in the system is helping to keep the economy intact. And yet again, below the surface, there's plenty of fragility. There's still, lots of haves and have-nots. And so it's not, it's part of the reason why I don't think you get the full bullishness is because there are things you can look at and be concerned about.
Yeah, because
one of them being COVID for sure.
yeah, definitely. David, that brings me to this question where how do you have a market melt up in an inflationary environment? I mean, how do the two exist?
Yeah, it's a good question. I think what you're going to see, there's, again, people tend to want this thing to work in a very linear fashion. And they say, okay, the Fed's printed. You've seen the market go up, that liquidity is gone, what have you. There's plenty of money out there looking for a home, and you don't get any returns in money markets or savings. You don't get very good returns in bonds, and certainly bonds have been selling off. The lesser quality even more so in recent months. So there's not a lot of places to hide other than equities, or not a lot of places to go to look for returns. So it is that situation where else do you go? I think that's part of it. It rotates from sector to sector, and recently there's been some movement into more defensive sectors. But overall, it becomes a case where the earnings support it. The valuations are high, but they're not super extreme, except in certain stocks. So people feel comfortable saying, well, there's really nowhere else to put my money, and right now I don't see any extreme signs that we're at a top.
I guess I have to ask this other question: has the Fed taken us into moral hazard territory?
That's a hard question to answer. There's a whole camp out there, led by the Austrians, who would like to abolish the Fed and just basically have said they're the reason we're in this mess. And if we didn't have them, we'd be much better off. My problem with that argument is, where would we be, in March 2020 going forward, given what we've seen in terms of COVID and the government wanting to shut things down, et cetera? Where do you think we would be? And given that we've got, at that time had 250 trillion in global debt, now up to 300 trillion. But where would we be if the Fed and the other central banks didn't push out that liquidity? We'd be in a whole lot of hurt. And it's easy to talk theoretically about, let's cleanse the system, let's stop pushing this thing. The problem is, it's number one, it's not realistic. There's no government on earth that's going to allow the kind of debacle you would have if the Fed didn't step in, or if the central banks didn't step in. So that's number one. And number two is, if you really wanted to follow that through to the end, you would see a mess that we would not come back from. You can say cleanse, but cleanse isn't something where you wipe it clean, and a few days later you move on, or a few weeks or months later you move on. Cleanse would mean years of suffering before we really, got traction again. So I just don't think it's a nice theoretical argument about should the Fed have done this or not. Realistically, it's the only game in town. It's the government provides supportive measures in terms of their fiscal expansion, and the Fed monetizes it, and it's just not going to stop. At some point, and I've got a pretty bearish outlook for next decade, not this decade, in terms of a collapse. At some point, it does come to an end, but I think it's unrealistic to think it's going to come to an end willingly. It's going to come to an end because things get to an extreme that they can't handle, and it just collapses unto itself. But that's not now. I am calling for a bust, as you know, but that's not, that we can come back from. What I think we see in 2030s is something far different.
Okay, what makes you choose or look at that date 2030?
Because I'm forecasting a global bust for later this year. And I define a global bust as a downturn bigger than any we've seen since the Great Depression, a downturn bigger than anything in the post-World War II era, and one that will be accompanied by a very big financial crisis with major bank failures, et cetera. So I think that's coming later this year. The response, when you have central banks having the ability to print, they will print to try to pull you out of that, and they will print so much more than we've seen in the last 2 years in response to that bust, and that will give us a inflationary recovery cycle that will carry through much of the balance of the decade. So if the bust starts, let's say, second half of this year, it probably carries through the middle of next year, and then you start a recovery cycle. And I think so that will be later in 2023, and I think you'll have a 5 or 6 year recovery cycle that will be driven by infrastructure spending, driven by industrial spending, and push commodities through the roof. You'll see a very, very dramatic commodity cycle. the problem is that all leads to hyperinflation. And, it doesn't all happen in 2 years. It takes time to play out, but it will happen, I think, over 5 or 6 years. So by the time you get to the end of the decade, you're looking at, I think you'll have retraced all of the last 40 years of disinflation slash deflation, if we get that in the bust. And you'll be back to 20% inflation rates in this country, as well as 15% long bond, maybe higher, 20% T-bill rate. So you'll have fully retraced that 40-year cycle, or that 40-year drawdown in rates. And with the 300 trillion, that will probably be over 400 trillion by then, maybe approaching 500 trillion in debt globally. And this will be happening globally. So everybody's going to have high inflation, high interest rates. How do you fund that? How do you service that debt? So that you get that, you're on a collision course between very high interest rates and excessive debt. And it's just impossible. We've been able to kind of service the debt because rates were so low. If you get that, all of a sudden, that big spike up in rates over a course of a few years, you're between a rock and a hard place. There's no answer. How do you fund it? You don't. They'll start by issuing more debt to cover the service costs, but that ends very quickly because it just keeps ratcheting up. And then, so in my opinion, again, it's not a precise number, but sometime in the next decade, early in the next decade, I think this all comes to a screeching halt and a crashing end. Basically, I think what we're in is a massive Ponzi scheme.
Okay, so David, within this time and this sort of a recovery, are we going to see things like QE happening again?
I think QE will be a big part of the response to the bust. Right now, obviously, they're tapering, and with the plan to get down to zero ease by the end of the first quarter. So, right now the Fed's pretty much on automatic pilot in terms of pulling money, slowing down the increase in money supply. By the beginning of the second quarter, they will no longer be easing if they follow through on what they're saying now. Unless something happens in the next couple months to change that, I think that's likely to say, okay, in the March, we're done easing. That does not mean immediately we go into hiking rates and tightening. They may choose to sit on their hands for a couple months, or they may say inflation's really out of hand and it's starting to accelerate further and we have to tighten right away. I see no hiking of rates before the second quarter, and I have no way of knowing whether it will be second quarter or third quarter or fourth quarter. But at this point, I think we're going to see the taper follow. I think they're going to continue with what they have said they're going to do, and we just have to wait and see what the next few months brings. I'm expecting a pullback in the market here and then a big melt up. If that melt up is happening in the first quarter, as I expect it will, that's probably going to have them responding to what looks like certainly an overheated capital market, and maybe accompanied by an overheated economy if that continues to open up. And that would probably tell you that they would be hiking rates before mid-year.
And do you see a market correction or severe market correction happening between the taper and if they can decide to raise rates?
Yeah, what I see right now is the likelihood that we had between October and now, basically between early November and now, we had two drawdowns in the market. Both of them, the S&P went back to 4,500 both times. NASDAQ went back to 15,000 both times. And we had this last kind of rocket ship up, combined Santa Claus rally, year-end rally type thing. And you had a lot of people saying, oh, this is the melt up, here we go. And I kept cautioning, saying, I don't think so. There's some things that didn't happen during those first two pullbacks. So it looks to me like we're likely in the next couple of weeks to have that third pullback back into that 15,000 NASDAQ, 4,500 S&P. And I would not be surprised to see the NASDAQ get down to 14,500, 14,500, 600, and the S&P get down to say 4,400. So actually go lower than the first two drawdowns. But to me, it's all part of the same correction that started in November. And I think it does kind of clear the air, set up the sentiment in such a way that then you can really have the melt up that I expect to be a rocket ship. I mean, I think it's going to be a stunning rally. Could all happen in the first quarter, could spill into the second quarter. A lot depends on how fast it gets going and how steep it gets, because I think it's going to be parabolic at the end. So if it really gets going, I think people are going to be surprised. The term melt up gets thrown around a lot, but I find most people using that term are thinking it's just another rally. It's going to be something we haven't seen. If it's what I am expecting, when I use the term melt up, it's something we rarely see. It's going to be stunning. And I think that's basically, later January through March type of an event where you could cover, from 4,500 on the S&P, you could go up easily 1,000 points, maybe 1,500 points. And if you do that in 3 or 4 months' time, that's a melt up.
Question though, when this melt up is happening and you're thinking that or seeing that it's going to be parabolic. On the flip side, when it starts to melt down, I mean, are we going to see a plateau of this melt up before a meltdown, or you think it's just going to be a violent downward spike?
Yeah, that's a great question. Most tops, and this is the granddaddy of tops, it's basically, in my opinion, I call it a 39-year secular top. So it started in August of 1982. It's all been driven by disinflation and lower interest rates, along with good earnings. But and so it's a top unlike any top we've seen in my career and your career certainly. And so when it tops, the likelihood is it's not touch a high and then roll over. It's probably going to be one of those things where you may go down quickly soon after you reach a high, and you might go down 15% or 20%, and then come back and retest, not all the way back to the highs probably, but 2/3 of the way back or 3/4 of the way back. So that let's say I'm just going to throw out a possibility. Let's say that you can get to 6,000. You might take 1,000 points off that 6,000 in a very quick order, as all those people have said, oh, I want to get out. I don't want to, when we get this melt up, I'm going to take advantage. I'm going to get out. And, you could see 1,000 points come out of it very quickly. I don't know whether that be a matter of a couple of weeks or a month or what, but, and then, whether the Fed steps in or not, something happens to trigger a rebound. And that rebound might take you back, from 5,000 to, 5,700, let's say. And I'm just throwing out scenarios, but, and then you roll over. So it's possible you could go straight down, but more likely you get some such, first down and then a step back up and then down, in a much more dramatic, longer term fashion.
Okay, talking about this melt up, do you think guys are gonna know when to get out, or you think a lot of people just are gonna be kind of going along for the ride and not really seeing a meltdown coming?
Well, if I'm right, and sentiment's really the key. If I'm right, this skepticism that has led to this long, 21-month rally that has just kept going, or bull market has just kept going. If I'm right, at the top and on the way to that top, that melt up is going to have people, they're not going to just say, oh yeah, I'm staying in because it's really exciting, but I'm getting out once I see concern. No, you're going to see a change of sentiment, and it's going to be all in. People are going to be telling me as I start getting cautious, people are going to tell me I'm nuts because this thing has legs. It can run for 2 or 3 more years. There's nothing in sight that's going to stop it. And so my guess is at the top, the sentiment's going to be the most bullish we've seen in decades. And that it's going to be, those people that are cautious today telling you they're going to make sure they get out before are going to have a hard time getting out. That's typically how it works. But the other thing I have to say, when you're talking about this kind of a move, it's not about precise timing. I'm throwing out a scenario saying it could happen by the second quarter. If this thing wants to push out, if certain things happen in the economy that stretch it out, that could happen. And certainly it's possible, you have 2 scenarios in terms of what drives it. One scenario is that the economy really opens up here because the inventory situation improves. The auto companies probably lost out on 3 million sales last year because of inventories, because of supply chain issues. If that gets cleared up to a great extent or to a good extent, you've got a lot of pent-up demand. So you could have very strong auto and housing sales and other things coming along, industrial economy doing pretty well. And that could fuel the melt up. On the other hand, you could have a situation where, the bond market's been, the yield curve's been flattening. The bond market's doing the tightening for the Fed. The Fed hasn't tightened yet, but the bond market's tightening to some extent. You could have a situation where the Fed's, 2 months from now looks and says, wow, the economy's not as strong as we thought. Inflation's slowing down. We're abandoning our taper and we're going to go back to providing some liquidity because we're concerned and concerned with the economy slowing down. And that could be the trigger for, a lot more upside because, no longer is inflation the story or concerned about tightening the story. Now it's all, it's all in again. So it's really a question at this point as we enter a new year, which of those scenarios plays out. Either one could fuel the melt up. Right now, I'm betting it's the, strong economy, stronger inflation that pushes, you get this red hot earnings picture and economy backdrop. And that's what fuels the melt up. But it's possible you could have the other.
Okay, David, you laid out a pretty interesting scenario there, but how does the Fed then define normalcy, normal monetary policy with all these things going on?
Hey, that's been an age-old problem. People think it's just very simple to sit in a committee and say, hey, we need to, we're seeing things that we need to react to or we need to anticipate. There's always cross currents. I mean, this isn't anything new. You go back to when I first came into the business in the early 70s, there was in the 73, 74 crash, there was plenty there that, they were trying to react to and didn't pick up early enough. We certainly know that in the 1980 to 82 period, you had a double dip in the economy. The Fed is doing their best to look at stuff, but the problem is they're looking at data that is backward looking to try to determine what's going on forward. And so are economists, across the board. As a result, oftentimes things catch them by surprise. So, the cross currents right now are nothing new. COVID throws in a new wild card. Is Omicron, the less virulent form that's kind of normalize things, or is Omicron going to shut things down? They're not able to answer that question. You got to just kind of keep watching things as they go along. You've got supply chain that's still an issue. How much of inflation is transitory? How much it has legs? The one thing that I kind of am expecting is, from my time back in the early 80s, is that once inflation breaks out, it just doesn't get put back in the bottle very easily. So, I just think that's the more likely scenario, is that as we move through the first quarter, inflation's only going to become a bigger problem and keep the Fed moving towards tightening.
Okay, with inflation, I believe you've said a few times that inflation drives gold and silver, and we have inflation going up, but gold and silver prices, they don't seem like they've gone along for that ride yet. What's holding back the gold and silver price?
Yeah, that's a good question. I think one thing is certainly the dollar. The dollar came into this year having a pretty oversold condition, and expected a several month bounce or several month counter trend rally. It's turned out to be pretty much a year long rally, or certainly a rally up into the fall, and then has kind of gone sideways for the last couple months. I think that as much as anything is holding back the metals. And I just think this is more technical, but every time the metals started to run, people jumped on the bandwagon, and the bulls came out of the woodwork after you thought you had a bearish bottom, and they just kind of jumped back in. This time around, it feels a little different. People are more skeptical of the rally because they said we've been here before. But I think inflation and a weak dollar are going to be the driving elements, along with very negative real yields. Nominal yields are going to be moving up, at least in my forecast, but I don't think that matters because I think the real yields are so negative.
Are gold and silver still an inflation hedge?
Yeah, I think so. I think you're going to find, again, the other thing is the markets have become so trader oriented. And, I grew up, before I was a strategist, I was a pension fund manager. And, you have much longer type investment horizon. I just find people, they want everything to happen today. It's, so they're watching it day by day, and it feels like you're watching, water boil. But I do think that ultimately, the real thing is markets move when they're ready. And we've had a, well over a year consolidation in the metals after a big run from March 2020 to August. And I just think they're ready. They're starting to show signs of breaking above some resistance and some trend lines. And I do think, first half of next year is going to be very strong for the metals.
Okay, we're just starting out 2022, but where do you see the metals going? You said breaking above some trend lines. You see them, maybe silver getting back to 25, 26, gold getting back to 19, 2000?
Oh, I'm way beyond that. I think in the first half of the year you could see gold up to 2,500. I think you can see silver at 50. And I was surprised the other day to have somebody tell me you're way too conservative. It's going to into the 60s. So I said possible. I think people think I'm crazy to be talking 50 when silver's down in the low 20s. But that's, I think they have the ability, once they get going here, to really have a big long run, and or certainly a steep run. In the bust, they'll probably have a good size pullback, a good size correction. Not like the stock market. I'm calling for an 80% bear market for stocks. They won't do anything like that. They'll, but they could come back to where they are now, or certainly gold could come back down to, the high teens. Silver probably stays, quite a bit above these levels because it goes so far. But then, beyond the bust in that 2023 to 2030 timeframe, I think the sky's the limit. I use a 10,000 plus number for gold. I don't know if that plus means 20,000 or what it means, but it's going to be a lot. And silver, I'm basically saying $400, and that may prove low. So there's, we're in a early in a bull market that had a great run from 2001 to 2011. That decade was great. Gold went from 250 to 1900. This one's going to be, I think, an even this is the next big leg after that leg that can take you from, ultimately 1650 at the low where it was this year, all the way up to, who knows, maybe 20,000.
Okay, very interesting. David Hunter, before we wrap up, please let our listeners know how they can follow you and learn more about what you do and perhaps even contact you.
Sure. I'm on Twitter pretty much every day, so they can follow me there at Dave H. Contrarian. So it's Dave H., not David. Dave H. Contrarian. And I also put out a quarterly investment letter by subscription. If they have any interest in that, they can direct message me on Twitter, and I'll provide details.
Okay, David Hunter, we appreciate the time you've given, and we wish you a very happy 2022.
Thanks, Patrick. You have a happy, healthy 2022, and stay safe.
Thank you. You as well. Thank you, David. That was David Hunter, Contrarian Macro Advisor, sharing his views. To follow David on Twitter, go to @DaveHContrarian. If you like this video, please subscribe, share, and give it a thumbs up. They really go a long way to help us do what we do for you. Audio-only versions of this interview can be found on iTunes and Spotify.